Once again, welcome everyone. Welcome to the Loan Review, a portfolio risk management tool webinar, or the Loan Review, the good, the bad, and the ugly. I'm Aida Musagic, Director of Phoenix B&H Consulting, and our presenter today will be Donna. The webinar series focused on risk management we have been implementing for the past 6 months is developed by Phoenix B&H Consulting and is supported by IFC in partnership with Swiss State Secretariat for Economic Affairs, or SECO. Prior to introducing Donna, our today's presenter, I would like to go through some logistical items with you. For any technical issues that you may experience during the webinar, please contact me. On the screen, you can see my email and my Skype handle. So please let me know if you have any problems during the webinar. During the webinar, all the participants will be muted. We will be recording the webinar, and the link to the recording will be sent to you with the follow-up email in 2 days or 48 hours. For your information, on the right-hand side, you can see the GoToWebinar panel, and you can see a handout section. So today's presentation is converted in PDF and attached in the handout section. You can download it. Besides the presentation, you can find a few other materials that Donna generously provided regarding the loan review. You can see the loan review checklist for SMEs and for the small loans examples. You can see the loan review report templates example and the memo Donna published on the loan review. You can submit questions during the presentation by using the question box also on the GoToWebinar panel. The questions will be answered at the end of the presentation. If by any chance we don't have enough time to answer all your questions during the webinar, Donna will answer your questions after the webinar, and the answers will be submitted or sent to you via email. So now I would like to introduce Donna. She is the Director of Phoenix B&H Consulting and a specialist in the area of international development finance. She has vast risk management experience, and she was a Deputy Director in the Corporate Risk Management Department of a big USA bank. She really enjoys completing loan review, and I know this from experience. She has completed around 50 loan reviews in different financial institutions of different types and sizes. I have known Donna for a very long time, around 10 years, and we are now partners in Phoenix B&H Consulting. With that, we would like to start the presentation. Donna, please take it away. Thank you.
Oops, I got to go back. Oh, there we go. Hello, everybody. Vast experience, Aida. Thank you for that compliment. I appreciate it. So today we're going to talk about loan review. And the question you might ask, why did you call it, or why did I call it the good, the bad, the ugly? Because I'm going to talk about loan review as a tool for a financial institution that gives loans. And as we know, in every portfolio, we're going to have our good loans, right, that pay on time. We're going to have our bad loans that are delinquent. But then there's these ugly loans too, or ugly practices and procedures, and maybe ugly is a harsh word, but that are not within maybe an institution's risk appetite. So this is why completing a loan review at the financial institution will let you know what's good, what's bad, and maybe what's ugly. So I enjoy doing loan review. I should give you some background. I was first at an SME loan officer for a number of years, and then I moved into the risk management department, and one of my main responsibilities in the risk management department at my bank was loan review. And I have a perspective of loan review as a loan review when I was a loan officer and implementing as a risk management person. And I think it's an important tool, and I could talk to you from both perspectives. So today I'm going to tell you what is a loan review, how financial institutions can use a loan review to their advantage, what's the steps involved, who should do a loan review, how often to do a loan review, how to use the results, and what are some of the common deficiencies I see when I'm doing a loan review in a loan portfolio. And then we're going to bring in Aida Musagic, Aida, who is then as an expert, because she has developed this at a number of financial institutions. As a practitioner, she's going to talk about real life experience implementing a loan review. So let's start. So let me give you an overview of where loan review fits in a financial institution. So as we all know, one of the main risks at any financial institution, or the main risk, can be credit risk. That is the risk will not repay the loan, right? As many of you, I know there's a group of a financial institution out there that know, what is my saying? No money, no mission, meaning the client doesn't repay us, we don't have a bank or a financial institution. We can't do our mission, right? So we need to have clients repay us, a majority of them. Of course, not all will, because we're in the risk business. So how do we manage credit risk at a financial institution, and how does the loan review fit into the management of the credit risk? So one thing I didn't understand when I was a new SME loan officer, I have to be honest, my first year, I probably wasn't the best SME loan officer. I didn't understand credit risk. I thought my goal was disbursement and pleasing the clients. I did not realize that the bank really, that I needed to think about it from the perspective of a bank. So luckily though, my financial institution set risk boundaries for loan officers like me, the new ones, or the ones that are a little bit more risky. I was more risky. They said things like they have policies and procedures, right? So I had policies and procedures that were very strict of who I could give a loan to and how to give a loan. An institution will also have performance indicator benchmarks, meaning that a loan institution, maybe a financial or a bank, will say, we do not want our portfolio at risk, our loans over 30 days late over 5% it has to be less than 5% of the portfolio. And then you also have credit approval that was approving. So a loan officer, thank God, as a new loan officer, I wasn't allowed to approve my new loans. Let me tell you that there was a credit approval at a committee that was looking at my loans. So those are kind of the risk boundaries or even gates that we have. And they're normally adhering to a financial institution's risk appetite. Then you have after disbursement. You got to be looking at the loan portfolio and managing the risk, measuring it, okay? You have two ways we do this. Financial institutions do it many ways, but two ways that I think of is the reporting, right? There's lots of reports in financial institutions. Portfolio at risk, delinquency by product, by loan officer, by branch, by this, by that, because they're monitoring it to make sure that that risk stays within the limit that is acceptable to the financial institution. But we also have loan review, and this is looking at loans after disbursement. So I'm going to talk to you a bit about that. And then finally, you want to testing and you want to verify the amount of risk, right? So you may see in a report that there's some risk there, but you need to look about the amount. And again, we have loan review. Another way that's done, there's many ways in financial institution, but another way is annual monitoring maybe of larger loans to cross-check. Has the situation changed with these SME loans? And if it has changed, is there more risk in the portfolio? So that's how we think about managing risk, and that's where loan review comes in. So what is a loan review? Okay, I want to be extremely clear about this. This is a review of the loans after disbursement. Okay, this is after the loan is closed and it's out the door. Normally within 1-2 years of disbursement, usually within the first year, you're going to be looking at these loans. But sometimes if it's a longer term loan, it could be maybe after 2 years. Why? Okay, why? I remember as a loan officer thinking, okay, why are these people coming looking at my loans? Somebody already approved it. I'm making the credit decision. Well, it's a more in-depth look at what's happening at the loan, even after disbursement, the monitoring of it. If it's delinquent, how the monitoring of the delinquency is. But it also is looking back at the credit decision. Was everything there to make a right credit decision? Because again, the loan committee is not going to get every piece of information that's in the loan officer's head. So a loan review goes out and looks at these individual loans and assesses what was presented to the loan committee correctly presents, what was put in the loan underwriting analysis correctly presents the borrower so that the loan committee has the appropriate information to make a good credit decision, okay? It also, when we're looking at this, when we're doing a loan review and looking at these individual loans, it determines compliance to policies and procedures. It can look at documentation. Now, many of you might be thinking, okay, we have internal audit. They do this. Well, I'm going to tell you, yes, sometimes there's a slight overlap with internal audit and loan review because yes, we're going to both look at documentation, and maybe we're both looking at it determining compliance to policies and procedures, but there's this little added thing right there, provide credit risk management priorities. And I'm going to go into more depth on that. But that's really looking at that the loan officer correctly underwrote and looked at the red flags or the yellow flags and asked the appropriate questions and provided the appropriate information for the credit decision. Normally, in most institutions I've worked with, internal audit does not do this. They're looking at more compliance to policy and procedures and lapses or failures in documentation. They don't do this extra credit risk management step. Fifth, we can also in your loan review recommend practices or procedures to address the findings. I'll talk about that later, some recommendations that have come out of loan review. And then finally, for some financial institutions, like we did in the US, for larger loans, SME loans, you will risk rate them, okay, based on a number of parameters. There's a rating. And so with the loan review, that can cross-check that the rating is correct. You know, sometimes when I mean a rating, there would be one is excellent loan down to an 8, which is a loan that's going to be written off, that the client will not pay. So a loan will be risk rated, and that a loan review will cross-check the ratings to say, yes, that is the right rating, or no, it needs to be rated lower, maybe higher. So here's a question. How does management use loan reviews? But I'm going to take this from head office management, senior management, okay? How do they use that? And I should also say, in some institutions, like in the US, our loan reviews went to senior management, but they also went to the board, the audit committee of the board of directors. It was required by law that banks, regulated financial institutions in the US had to do a loan review annually, and that the loan reviews would go up to the board. So in a way, we were also the eyes and ears of the board, but senior management also used loan reviews they looked if there needed to be changes needed to current policies and procedures. They looked if there was training needs and not adherence to policies and procedures. So we are going to point out, yes, sometimes there was not adherence to policies and procedures, but sometimes that was an indicative that maybe loan officers needed more training. For example, Aida and I were at a financial institution, and we found that this is a financial institution that had a massive branch system, a lot of branches. And when we went out, we found, now this financial institution was doing quite well. I got to be honest with you, profitable, low portfolio at risk. However, when we went to each of the branches, we found out that there was some non-adherence to policies and procedures. Well, it kind of was that head office was giving out new policies and procedures, but the loan officers weren't being really trained correctly. Also, the branch managers were acting, I'm going to be honest, like kings and queens. They had their own little kingdom, right? And no one was cross-checking them. And believe me, they were not happy when we were coming into the branch and questioning them why they weren't adhering to these policies. I don't think this was fraud. Honestly, I don't think it was fraud. I just think they had started to amend the policies and procedures to work better for them. Now, honestly, we went back and we changed the policies and procedures at this institution. Some of them we changed that were more reflective of what was happening in the branches. But we also had to be a little bit harsher on the branches because we felt the risk appetite at the head office what the board had approved at the risk appetite was not being reflected in the branches, and the branches were being more risky. So that's how senior management and board of directors use loan reviews. It may detect fraud. So have I come across situations where there was non-adherence to policies and procedures, or in a loan I saw, and after I went to the branch, I looked at the loan, maybe I met with the client, there wasn't full information about the client in some situation? Could I have felt that there was fraud? Maybe I want to say, I sniffed it, but I can't say that it is, because I wasn't going to investigate. So I would turn that, it would be written up in my report, not that it's fraud, but I would point out the non-adherence, and maybe internal audit would get this report and then investigate. Additionally, if risk grades are used for larger loans and they determine a loan loss reserve, this is a way to look at the risk grades are appropriate, as I discussed. That's senior management. Let's talk about the branches. Let's talk about the branch managers, okay? Let's talk about even the loan officers. So how do they feel and when I go into an institution and I implement this new practice of loan review, right? Many times it's coming out of the risk management department. That's them. Not kidding you. I swear to God, some people looked at me like that, unhappy. And even me, when I was a loan officer and people would come in to look at my loans, right? People think we're the police. Are you reviewing me? Why are you doing this? I'm the loan officer. Have you ever made a loan? But I learned as a loan officer, and good branch managers realize that they should be more like this. Okay, nobody welcomes a loan reviewer with open arms, but they realize the benefit to the entire organization, right? You can't have your own kingdom in a branch, right? It's not your money you're lending out. So it has to be, the financial institution has to set the risk appetite, and branches need to adhere to it. So good branch managers will welcome us because they realize a loan review is actually helpful for branch staff. So how is it helpful? Excuse me. Again, training needs, non-adherence to policy procedures. Branch managers are some of the busiest people in a financial institution. I don't think I've ever been in a financial institution where I have never seen a branch manager trying to fit 12 hours of work into 8 hours, because they have to manage staff, look at clients, approve loans, go meet new loans, try to, deal with operational. You guys are doing so much, branch managers, okay? So you don't know, and you can't sometimes understand if there's training needs, or if maybe your people are not adhering to policies and procedures. So this is helpful for you. But another added benefit for branch managers and for branch staff is that we go out sometimes when I do a loan review and I see head offices implementing a new policy procedure. Maybe they say disbursement or approval within 24 hours, disbursement within 48 hours, or maybe they're introducing some new product and they're saying, no, you need to, you have to disperse this number of loans of this new product. And I realize, wow, this can't work. Like in the branch, when I'm talking with branch staff, because an important part of doing a loan review is also talking with loan officers and the branch manager of what's really the reality at the branch, is that what head office is saying should be done can't be done or is not realistic. So I can write that in my loan review. And I don't say I'm not going to say bad head office, right? But I'll say that in reality, that branches can't adhere to this policy because of this, this, and this. And a lot of times I've seen head offices, senior management change policies and procedures when they realize, okay, this is not realistic, let's be more amendable. So this actually can have like the reality of what's happening at the branch, good and bad, and how hard you work can be given up to senior management. So let's talk about the steps involved in a loan review. So step one is the loan selection. You can't look at every loan in a financial institution, but we need to be able to look at a sufficient number of loans to make an educated assessment of the risk within a portfolio. So First thing you do is, if I'm going to look at a branch or a department or a bank, like we in the US, we had 3 banks, and we had 3 different departmental types of loans. When I would go look at the department, excuse me, I would pull a list of the loans as of a specific date, and then delinquent loans. And then sometimes the list of loans would be by product, by loan officer, because I want a sample of the portfolio that shows all the different products, delinquent problem loans. I also want to look at what are some riskier loans, restructured, reprogrammed, refinance loans. And I want a sample of all loan officers. Now, of course, you're going to base your loan selection sample on the risk. So for example, if I go into an institution and they have maybe 5% of their loans, of total loans outstanding, is loans to schools or school loans, but it's a tiny percentage. It's never going to be larger. I may look at a couple of them, but since it's not a huge part of the portfolio, it's not going to be a high risk. However, I'm going to look at like restructured loans, refinance loans, or maybe large loans, because large loans, meaning if they're significant, like large SME loans, could have a huge impact on the financial institution if they go bad, if the client stops paying. So if you notice, I wrote best practice is to review 15 to 25% of the outstanding portfolio. Now that's the best practice. That's a dream, okay? I'm going to be quite honest. But what you need to do is get a sample. Maybe it's only 5% of the portfolio during the entire year to understand if you have any systemic issues. That means I can't do a loan review. I can't go look at one loan and say, okay, this is bad, so everything is bad. No. I have to look, like let's say if I go into a branch, I've got to look at, 50 loans, if it's a large branch, to understand what, if there is a problem, if there is a problem that is systemic, meaning many loans have the same problem, or is it just one loan? One loan cannot be a presentation and present that there's something wrong in the portfolio. So step number 2 is the actual file review. And I say, and maybe this sounds, kind of funny, but I tell people, if you let me go into your loans and look at them for 3 to 5 days, I can tell you the problems in your loan portfolio. I can sniff it out and maybe potentially meet with some clients. But the checklist is really important because that will dictate the questions and the areas I'm looking at. So we normally have about 6 categories on the checklist. I'm going to show you some examples. We have credit initiation, the credit decision, loan structuring, loan approval procedures, the file documentation, and then we have performing loan monitoring and problem loan management. On the handouts, you have 2 checklists. I actually left them in Excel for you. And one is for SMEs and one is for smaller loans. Again, one checklist doesn't work for every institution. You would have to edit this. But I wanted to provide this to you in case your financial institution wants to start looking at this or is interested in what checklist I have used. Again, looking at these loans, you're going to have to understand if there is a systemic or an individual risk. Systemic means 10% or more, meaning, so if I look at 50 loans and out of the 50 loans, 5 to 10 of them have the same issue, it can be indicative that this is a problem through the entire loan portfolio. That is just not one off. So let's look at the checklist. This is an example of an SME checklist that actually was used, I think, about 10 years ago, if I remember. This is a specific loan portfolio I remember well. And as you can see, each column is a different loan. And I have shown you the section called credit initiation. So somebody would go in, look at the loans, and answer all these questions for the individual loans. So under credit initiation, I want to give you a few questions that maybe will show you the difference between loan review and internal audit. So the first is highlighted financial spread and analyzed, and the second one, primary repayment source analyzed correctly. Those go together, okay? So as many of you know, what is the primary repayment source for most financial institutions? It's cash, right? It's the client paying cash, usually from a business. So what this is asking you is if the financials were spread and analyzed, and then we looked at that the cash was analyzed correctly. This doesn't mean a loan officer has just especially with clients who don't have audited financials, that we ask them, what's your income, what's your expenses? We wrote it down and we didn't think about it. This is that it shows me that they thought about it and asked the right questions. Sometimes when I'm looking at a loan, especially for this question, I will go talk to the loan officer and just in a friendly way ask them how they were looking at this, why they did this. But sometimes it's pretty obvious, especially if you're doing microfinance loans and you can see that maybe the finance, like there's kids in school, but then they didn't put any school expenses, then you would wonder, are they actually doing these correctly? The secondary source analyzed correctly is usually guarantor or collateral analysis. Now, let me give you an example of this in a financial institution we looked at. They had that it was a small business loan and they had property, agricultural property as collateral. However, and they valued it and it was sufficient to cover the entire loan amount in case we needed to take the collateral if the client stopped paying. But then we dug deeper. When I went and looked at the file, we found out this agricultural land was in the middle of nowhere. There wasn't even a road to it. You had to walk through someone else's land to get it. The value of this land was literally probably nothing because it was not sellable or saleable. No one would buy it. Marketable, that's the correct word. And there was no market. No one would buy it. So even though they said that the amount, I think it was $50,000, it really probably was worthless. So it wasn't analyzed correctly, right? You had to dig deeper, this loan officer obviously didn't think about this. I have another good example of this. This is a funny example. I went in as a chief risk officer for a financial institution for a while and found their biggest problem loan was a circus. This was in the US. It was a huge loan, over $1 million. And our collateral was land, a very rural area in the state that had the practice tent. So when the circus wasn't running, people would go out and there was a big tent and people would practice out there. When I looked at what the value of the land was, I realized the marketability again was much less. And what we found out was that the original analysis was incorrect. And the value of it was actually probably only 25% of what they actually said it was originally. So it wasn't analyzed correctly by the loan officer and actually by the credit committee too. I'm going to be honest, you can't always blame the loan officer. Sometimes it's the credit committee that's not making and not analyzing like they should. So here's a microloan checklist. It's a bit different. This is the credit initiation and underwriting section. Again, you will see it has cash flow completed correctly, financial analysis realistic. And I say realistic here because a lot of times, as we know, with microfinance clients, the loan officer is developing, right? The loan officer is developing the cash flow, because the client doesn't have any financial statements. So you're actually asking them a question. So was it this financial analysis that was developed realistic? One question I didn't highlight that I want to mention is it says character assessment completed. As we know, when I ask any smart microfinance loan officer or branch manager, is character or cash more important? It's at least equally important to character, if not more important. And so how was a character analysis assessment completed? That is that being done also? Meaning, are they looking at their repayment history, right? Were they transparent giving information? Were they forthcoming giving information? So there's some things I know good loan officers do with microfinance to assess the character. And was that completed and written down? So now we're going to have a poll question. Aida?
Okay, we are launching the poll. And the question is, in which situation should the loan reviewer visit the borrower? There are 4 options. If the client provides audited financials, if the client cannot provide financials, if the client has more than one loan, or if the client is new. You can actually choose more than one answer. So we are going to give you 2 minutes to select your answer. Thank you.
I look forward to your answers on this. Aida, how are we coming along?
So we still have people voting. 38% voted. Let's just give it a few more seconds. Okay, I think we are ready to close the poll.
Okay, interesting. So we're saying majority say when a client is new, more than one loan, cannot provide financials, or the audit financials. So I'm going to be honest with you. They're all correct, okay? So let me go through each. So if the client provides audited financials, normally we don't need to visit them. If you can trust the audited financials, there is just, I remember 2 countries I've worked in that there was actually audited financials, but I got to say that they maybe weren't always completely representative of the financial institution because maybe they were just compiled. Majority of times you will not have to visit with audited financials, but it could also depend on the quality of the financial statements. And maybe you don't visit the borrower, maybe you can just call them and have an interview in that instance. Okay, client cannot provide financials. Absolutely, this is important to do a sampling of this because this is probably mostly for very small loans or micro loans where the loan officer has presented the financials, has developed the financials on their own with questions by questioning the client. And what is important there is that we need to understand that what is presented in the analysis, in the analysis that was provided to the credit committee, correctly represents the situation of the client. Because the worst thing is a credit committee giving a loan out and then the loan goes bad. And then we go look at why did the loan go bad? And we realize, well, the credit committee didn't have all the information. And maybe it was bad loan officer didn't give all the information. Maybe it was a bad template because the template of their underwriting analysis didn't allow the loan officer to give the information. Or maybe the loan officer just wasn't trained to understand red flags. But it's very important, especially when they're not provided audited financials in very small businesses, that you actually look at the client situation and that loan officers are understanding what information needs to be provided to the credit committee. If the client has more than one loan, or the client is new, yes, in both instances you want to look at that client to see, maybe cross-check, especially if they're new, or if they have more loan and they have more risk, right? Why do they need that new loan? What always is a red flag for me when it's very small loans, business loans or micro loans, is when we give a client a loan within maybe the first 3 months after the first loan, and all of a sudden a second loan is given within 3 months. Is it because the client is expanding? They're doing so great, they need to expand the business? Great, I'm happy about that. But what pains me, and I've seen this in some institutions, is that we give the loan And then we didn't do, as a loan officer, the financial analysis correctly, and we have to give them another loan because they're having a difficult time paying. Okay, I got to be honest, I've done this. Remember when I was a loan officer my first year and I wasn't a very good loan officer, I didn't correctly assess financials well, and I wasn't trained well my first year. And so there was a number of times that we had to bridge or give clients, restructure them because I didn't do the financials correct. So I think in all instances, it just depends on the situation, but definitely when they cannot provide the financials is the number one reason. Okay, Aida, can we go back to the presentation? Do I have control? There we go. Okay. So when you're interviewing a client, this is an example of actually a client interview form, and actually in the checklist that I provided, I think for the small loans there is a checklist in there of the client interviews. Normally I will do a couple of things. So remember, I'm looking at loans that are already dispersed. But what I will do is, especially with very small loans, I'll look at the income statement or the income statement or the monthly cash flow that was developed by the loan officer, and I'll actually write it down and I cross-check it with the client. Now, as a loan officer, I know some loan officers and branch managers are like, oh, why are you bothering our clients? Don't bother our clients. Again, we need to bother your clients. We need to understand what's happening out there. A good loan reviewer will do it in a very delicate way and will be quick with the client and not bother the client, and has some specific questions to understand how the financials were developed, if they were developed correctly, and then also look at the business situation. Now, this checklist that's on the screen actually was developed for one specific financial institution. They allowed for payments to be taken in the field. As we all know, as people in financial institutions, payments taken outside the office or taken outside of a bank is very risky. So this last question, for example, was always asked to, and then we wanted to see the receipt because we wanted to make sure, because it was a very high risk practice that if they were taking payments outside, that the receipt was given. Okay, that's the client interview. So the final step is a report that's issued, okay? So we go out to a branch, we do our loan review, and then we issue our report. So the first thing we're going to do is some summary results: high, medium, low priority findings. There usually aren't a lot of high priority findings. These high priority, and you will see in the white paper that is in there, is really something that could financially impact the organization. For example, I went to do a loan review at our bank in Cleveland. Now, this was 20 years ago. Yes, I'm much older than many of you. But so I give them the list. I think there was a team of 3 of us. We were looking at like 100 loans. They were SME loans. They couldn't find one of the files. Now, this is before digitalization. This is before we were copying things. They could not find the loan agreement, the collateral, nothing. I was there a week. They never found the file, okay? Now, this was a high priority finding. Even though it was only one file out of 100, we could have lost money, or it would have been costly to go to court. Let's say the client stopped paying, we didn't have a file. We need to go to court to prove that he signed this loan agreement and that he had to pay us back. We're paying legal fees. It's a long process, or he never pays us and we can't prove it. So this was a high priority finding. Some other things we found is I remember doing a loan review for a large financial institution, and they did a lot of loan restructuring. Okay, so a loan would become a problem and they restructure it so the client could pay, but they weren't doing it. The practices were unacceptable, meaning at the credit department wasn't approving, there wasn't a full analysis. So it was a high priority finding because it was a substantial amount of the portfolio. I think about 15% of the portfolio they had been restructuring. And I realized that the restructuring was not being done correctly, the assessment. So it was a high priority finding because with these restructured loans, we also had a high percentage of them being delinquent, which indicated they weren't being restructured correctly. A medium priority is normally one that's not adhering to policies, okay? So maybe some lack of documentation of something, or maybe that was the main thing that we'd see. So non-adherent to policies. Maybe the financial institution's not going to lose money, but it's not adhering to the risk appetite of the institution. And finally, low priority are usually just recommendations to do things better. For example, we had one institution that we were recommending that maybe photos of the business be in the file. And again, this wasn't going to be, if it didn't get implemented, it wasn't a huge impact, but we just wanted to make some practices better. So then we have a credit risk management summary, and I'm going to go in the next slide over that we're going to look at each section and say, is that satisfactory or that needs improvement? Then we have the financial and documentation exceptions if there's documents missing. And then we have a management's response, okay? And if we're doing a loan review at the branch, we had to finish our report within 3 to 5 days at risk department. We had to hand it to the branch manager to review, and they could respond to the findings, because then afterwards the report would go up to senior management, internal audit, maybe even to the board. We always wanted to allow management to respond to what they found. So here's an example of a credit risk review summary that was presented. So again, this is actually from a loan review I did for a financial institution, and these are the categories we were looking at: credit analysis, documentation, approval, normal loan monitoring, delinquent loan, and then portfolio monitoring. And then we would rate this as needs improvements or satisfactory. I remember this institution that had a lot of issues with their credit analysis and underwriting training, and I think people not adhering to policies and procedures, and that needed a huge amount of needs improvement. But if I say it's needs improvement, then I have to back it up with documentation of what needed to be corrected. I just can't, this is not just a judgment, and I can't, it just is not it has to be very objective, and it has to be backed up with data, because I'm not going to criticize a branch, I'm not going to criticize a department until I have proof or information to back up what I'm deciding. So other questions. Who should conduct the review? People not involved in the credit decision process is the best. How often? Now, in the US, we would do these annually or semi-annually, but in some institutions, they couldn't take, a week or 2 weeks to go do a loan review. So sometimes they do it quarterly, or they do a small sample of each branch on a monthly basis. A lot of institutions who are doing loans at the branch level will go and do it either at a monthly or quarterly. And how do we use the results? We modified policies and procedures. We changed them either to be better, or maybe to be stricter, or to better represent what's happening that was acceptable out in the field. We'd organize training. One institution we found, this is the one where, remember, a lot of branches, people had their own kingdoms. We needed, the head management, the director said, you know what, we need to modify the policy, and then you need to train 220 loan officers, which we did. And we tested them on this policy because we realized the risk appetite, what the board thought the risk appetite was not at every branch, and we needed to make it the same. We also changed templates. Many times loan officers, they know information about the client, but there's nothing on the underwriting template to allow them to present this information for the loan committee. So many times I'll recommend that templates need to include additional information, additional sections, so the loan officers can present the information, that they need to do. So common deficiencies, very briefly, and then we're going to have our expert. Wrong cash flow analysis, not asking all the questions, not looking at red flags, lack of understanding of specific policies or procedures. Maybe head office implements something new, but no one is telling the loan officers or explaining it to them. Not adhering to collection deadlines. Most institutions have timelines for collections, and I find in many institutions that people aren't checking if they're adhering, that a specific letter needs to be sent out at a certain time. And it's important, especially with collections, that it's all done in a systematic way. missing documents, as we said, and then information not written in the analysis or file. Again, the loan officer knows this, but it's not written in analysis or it's not included in the file. Not because maybe, again, there was just nowhere to put the information. Okay, I am going to have an interview with an expert. So Aida, we have probably about 5-10 minutes, I think.
Yeah, about 5 minutes.
Oh my gosh, okay. So let's do the interview with the expert. I talked too long. So Aida, briefly, I'm trying to, do you have it or do I?
No, you have it.
Okay, what is the value of loan review to management and branch staff? Very briefly.
Yeah, well, okay, so you already mentioned this, and I may be risking repeating myself, but it's actually, I was doubtful in the beginning, right? You actually introduced me to this tool. I was working in a financial institution in Bosnia. I was going through a crisis, it was 10 years ago, and you came in as a consultant. And I wasn't really sure what the goal was until we did the first one. And so, on one hand, to management, it actually tells them what's happening in the branches. What are the issues? What does the credit staff has problems with? Is it the understanding of the procedures? Is it the underwriting? Is it the products that are being difficult to assess and so on? And to the branch staff, the branch managers, actually, you made a good point earlier in the presentation. You said that some branch managers can be really defensive. But that happened the first time in the financial institution where I worked in as a risk management. After that, the attitude changed because the branch staff had a little bit more information about their staff in the branches, what they need to focus on, what they need to pay attention to, because it was also their business results that are being at risk if, for example, a loan officer has issues with underwriting. So it was very, very practical on both sides.
So who have you seen complete the loan review? Because I know you've set this up in a few institutions.
Yeah, well, in all the institutions where we set this up, loan review was done by risk.
Okay.
It was really, really important not to be done by the credit department. It may be a conflict of interest, and even if it's not formally conflict of interest, it can cloud your judgment if you are looking at the laws that you are in charge of, right? And even
Right.
the risk is approving loans. If possible, some risk departments have developed separate units that are doing the loan review.
And how did you select the loans to review? And I know you taught some institutions about loan selection.
Okay, so to be perfectly honest, we developed matrices on how to do the selection. So you can have the representation that it's quite detailed. But to be perfectly honest, when I was a risk manager, I was informed by my risk reports. I see a portfolio at risk higher in a branch or with a specific loan officer or with specific loan products. And if the portfolio is sufficiently large, that was my red flag and decided I need to do the loan review. So my first point of information were the risk reports. And then after the situation became a little bit more routine with the loan review, I actually used the matrix to select the sample.
And why meet with clients? Don't you trust loan officers?
Oh, I absolutely. This is also helpful for the loan officers because loan officers may be reluctant to share what they may be lacking in skills, or maybe not even being aware that they are lacking specific skills in the underwriting. So it's not, of course, as a risk manager, there's always issue of trust. But it's not only the issue of trust. You also want to help your staff perform the best they can. So I met with clients in order to understand what was the information taken by the loan officer like, whether the quality was sufficient, and also when I didn't have the audit financials. And of course, these small businesses usually don't have the audited financials.
And can you remember some of your major findings? I mean, it's interesting to talk about where you were a risk manager, because let's talk about it, because we entered this microfinance institution, and it was a crisis, absolutely crisis situation. It was a crisis situation everywhere in Bosnia. Let's be honest, every financial institution. But I'm going to be honest, this financial institution really made some significant changes. And 3 years, 4 years later, when you left, it was doing quite well, and it is doing quite well. So tell me the difference of your findings originally during the crisis and your findings. You were continually doing loan review when you left the organization. It was healthy.
You asked if I can remember. I still have nightmares. No, but in the beginning, as you said, when I started, the institute was going through a risk period and through a crisis, actually. So what actually loan review, what loan review told us was actually why the crisis was happening. Not the only reason, but certainly a major reason. And the underwriting was the issue in the beginning. So the loan officer simply didn't know what to ask, how to process the numbers, and the templates, the underwriting templates were not working. So we had to change the templates and the underwriting procedure, and we have spent a lot of time training those stuff. Later on, when the situation stabilized and the crisis period was over, loan review became a little bit more routine in scheduling, and the findings changed. They shifted a little bit from the underwriting to procedural things and documentation, for example.
So at the beginning, and then I know out of those major findings at the beginning, you made a lot of changes to policies, procedures, you changed templates, and you did a lot of training. And so it changed coming out of the crisis that it was just maintaining the risk. First of all, you had to get to an acceptable risk appetite in the institution when you began. But I remember then when you left, risk appetite was established, the parameters were established. You just had to make sure that everybody was maintaining and staying within that. And also the new product. I know you always would you were introducing new products, and it was very important for you to go out there and review them.
Every time a new loan product was introduced, we would be reviewing it after a certain period of time.
Yeah.
But we will be reviewing it.
So any changes over that time from crisis to was your sample different? Was maybe you lessened anything changed?
So So the sampling also, my approach had to change, right? Because during the crisis, the risk reports, the portfolio risk reports can actually they can show you red flags that were quite significant. So that was my main kind of guiding light on where to look and what to look for. But then when the portfolio stabilized and the portfolio became more stable over nice segments of the portfolio, so it wasn't so easy to find the red flags, then I use the matrix. So I can sample or across the approval levels, because we had different approval levels, right? The branches had one, and the head office had one, and so on. Across different loan products, refinance loans, we were always looking at the refinance loans, and whether the loans were in the first cycle or in the repeat cycle, and so on. So you have to have a good representation to understand what's happening.
I'm going to skip to how did you interact with loan review? Just briefly, how did you, as a risk manager doing the loan review, how did you interact with internal audit? Sorry.
With the internal audit, yeah. So I can give you an example. So it doesn't have to be the same. It can vary. But in a financial institution in Bosnia, internal auditor was not a member of the risk committee, but he was sitting at the meetings. Every meeting he was there. And I would present the loan review findings report during the risk committee meetings. So the internal auditor was actually aware of all the findings. And I would also send him the report.
Yeah, I think it's important to mention that the reports were sent to him, because some things, like we said, we couldn't say it was fraud, but he might or she might need to follow up.
Which the internal auditor did.
Yeah, so it should work together. The most frustrating thing I saw was when internal audit reports aren't going to risk management. The risk management reports, the loan reviews aren't going to internal auditor. I've seen that in some institutions, and that's just a bit disturbing. Okay, questions. And actually, I'm going to start with one because somebody just texted me one. And Aida, actually, you can answer this with me. Somebody asked us, how is digitalization affect loan review? Are there any new loan review techniques due to digitalization? So this is a fantastic question. And I'm old school because I did loan review on Excel, right? So I gave you Excel. But what we've seen now with the digitalization is a lot of the work can be done from head office, and you don't always need to go out to the branches. And what's nice is that it can be digitalized, it can be automated into your system to maybe, I've seen it where there's some parameters set up of what are high risk loans. These will come across risk management that they know they have to do a loan review of these loans that were approved, maybe do some exception, something that was something of the loan amount, the product, something has, and so these loans come. So digitalization allowed to identify these more quickly, and it actually has allowed for especially for SME loans, that you can sit in head office because everything is digitalized and everything is in soft copy, that you can do a loan review sitting in your office. And then the results, what I love is that if you have a digitalized loan review, then annually it's kept and it's not hard copy. So then you can compare the results year to year. Aida, do you have anything with digitalization in loan review?
Yeah, I agree with you. So I'm not going to repeat what you said, but digitalization of processes can help by facilitating the entire process. But also, I can give you an example of a financial institution that I worked with in East Europe, and they have digitized the underwriting process for specific loan products and specific amounts, right? So the entire initiation process is done by tablets and online. But what they did with the loan review, after a certain period of time from the initiation, they would actually check the information inputted by the staff in their online system, whether the information was had sufficient quality. So they would actually go out and meet the clients anyway. I mean, sample of the clients that were acquired through digitized processes and loan products.
Great. Any other, Aida, do we have any other,
So we have another. Yes, so we have another question regarding fraud. If the question is during the process of the loan review, if you detect a potential fraudulent activity, what's the recommended process of reporting?
Okay, I mean, if it's an obvious thing where somebody's stealing, like the client, I haven't had this, but I've heard of it from other loan reviewers where the client admits like they maybe gave a payment to the loan officer. Well, that immediately has to be reported to internal audits. I mean, immediately, and then that's happened. I've had it where I've gone out to visit a client. I had a funny experience in Pakistan. This is years ago. I go to visit a client. He had a little store, and I went up to the man, and it wasn't the same picture in the file of the owner. I went up to the man in the store. I said, "Can I speak to the owner?" He said, "I'm the owner." I said, "Is this you?" He's like, "No, this is not me." I said, "Who is this?" He goes, "I don't know." And so I go next door to the other store, and they're like, "Oh, that guy works as a waiter down the street." So we went and called that fake borrower, and he came in and admitted that he had done a fraudulent loan. We had to give that up to head office to handle immediately. So that's all you can do. I mean, again, sometimes you can't identify that as fraud, but you're suspicious. Again, you would talk to internal auditor. That you would have to follow up it about.
So we have another. Yeah, we have another question. So if the risk department is approving loans, is it not conflict of interest for them to complete the loan review?
Aida, I mean, you were approving at the beginning. You were approving loans and doing loan review. So tell me. I mean, I have my opinion, but I'd like to hear yours actually.
So yeah, as a risk manager, I did approve a specific segment of loan applications over a certain amount. But with the loan review, I would actually look at more than that, just that segment of portfolio. I would look across the portfolio. I would look at different approval levels, loans that I didn't see. And also it's different when you are approving loans from your chair in the head office and completely different situation when you have the opportunity to go out and actually meet the clients. So
Yeah.
I actually found it very useful. But I think we already mentioned this before, where possible, within risk, it's good to separate the two functions.
Exactly. So I know you developed it at a financial institution, and in the risk department, there was people approving loans, and you separated one or two people out that did not approve loans, but was doing this loan review and other responsibilities. So that I think is a better practice. Maybe a best practice is that they're not approving it. Because yes, I do think could be a conflict of interest, of course. Anything else?
So we have another question. I think we discussed this, but it's maybe be good to confirm. What is the main difference between internal audit and loan review?
Okay, so the main difference again is internal audit is usually compliance and documentation. They're not digging deep into a lot of the credit decision, and sometimes they're not going to follow up with the monitoring and looking at delinquent loans. Unfortunately, I find a lot of internal audit departments are just looking at, kind of loans that are dispersed in the last year, or maybe they're even looking at 3 years, but they're not looking at the monitoring procedures. Are people adhering to that? So that's the main difference. Do we have time? I have some other questions from somebody.
Yeah.
Okay. So, I'm sorry, do you have a question?
Yes, we had a question, can the results of the loan review be escalated?
Meaning to a higher authority if it's important?
Yeah.
Yes, I mean, well, this is, okay, so in the US, someone emailed me a question about regulatory. It is the regulators in the US require an independent loan review completed for banks in the US. Because I was my risk management department, I answered to the audit committee. So the regulators approved my department that we could do a loan review. But in many other banks, there is actually other outside consultants doing this. And I was lucky that my loan reviews not only went to senior management, but it went to the board members. So if I had a high priority finding, it was escalated. In other institutions where it's not a regulatory requirement and maybe they are not going to the board, I do think it would be a good practice that risk would report to the high priority findings to the audit committee or board members on a quarterly basis. So I think it should be in the policies and procedures that, okay, if everything is acceptable, then it doesn't need to be highlighted to the board. But if there's high priority findings, that it should be, these should be reported to the board on a quarterly basis.
No more questions on this side.
No more questions?
No more questions.
Okay, so one person just said my opinion regarding regulatory requirements for loan review, especially in developing countries. Unfortunately, in developing countries, I'm not finding any regulatory requirements for the loan reviews like I found in the US. And this is why at a number of financial institutions, including banks, I've implemented it. I think it's an excellent, and I would hope to see some more countries require this, because again, I think it's a really good way, especially if it's done by a third party that answers to the board, to understand the credit risk within the financial institution. I think we've hit the time limit. Aida? So
yes, it's 11:03. Sorry.
A summary, I just want to let you know we're going to have another webinar, but that we're still finalizing the dates for that next month. But we do have Fahim Ali, who did our previous digital and risk management webinars, agreed he's going to do one on June 12th, 2019, DFS technology implementation. So that's Wednesday, June 12th. Please save the date. Sorry, I'm trying to that. And we want to thank you. Please take time to complete the survey afterwards. If you want any more information or you want a webinar on a specific topic, please contact, you see our emails on the screen. Please contact us directly. And we thank you very much, and we hope you have a wonderful day.
Thank you so much. Have a great day. Bye-bye.